At Bloomsbury Wealth, we recognise that we cannot control the returns that the markets deliver, but we can select and manage closely the risks that our clients take in their portfolios and capture, as closely as we can, the returns on offer. It is important to recognise that risk and return go hand in hand. If you want higher returns, you need to take higher risks. Think about a fruit tree. If you stay on the ground, you eliminate your risk of falling and potentially hurting yourself. But you can also only reach the low-hanging fruit. As everyone else can do this without taking any risk, there is often very little of it to go around. However, for each little bit higher up the tree that you climb, the more fruit you can collect. But to do so, you must accept the increased risk of falling and injuring yourself. You should be very wary of anyone that tries to sell you an investment that has a high return and minimal risk. Their reasons for doing so will land somewhere on a spectrum that ranges from greed to incompetence. Just because the risk may not be obvious does not mean that it is not there. Risk and return are absolutely fundamentally interlinked. Your return is the reward that you receive for taking a certain level of risk. Each person has a level of risk, their risk profile, that is suitable for them when it comes to investing. This depends on their risk tolerance, their risk capacity, and their required risk, which is dependent on their required return. Risk tolerance is part of your DNA. It measures your emotional ability to cope with investment, uncertainty, or loss. When the stock market drops, as it inevitably will, it is likely that you will hear a variation of the headlines. Markets experience meltdown of the century. Will the markets ever recover? Or £2 trillion wiped from the global economy. If you have a low tolerance to risk and decide to bail out of any investment when market confidence in it is low and prices have dropped, you will experience a permanent reduction in wealth from which you may never recover. To determine a person's inherent tolerance to risk, we use something called the Ropemaker risk profiling system. It provides a more accurate evaluation of a person's tolerance than simply asking them how much risk they are comfortable with taking. Your ability to withstand financially the effect of a permanent loss of capital and/or future returns being lower than anticipated is called risk capacity. This represents your ability to live with the impact of such an adverse outcome on your lifestyle and other goals. The final element, your required risk, should be determined by comparing your financial goals with the resources in human capital, in the form of expected future earnings, plus your financial assets, that you anticipate being available to help you to achieve them. If the return that you need to earn on these assets is higher than that available from risk-free assets such as cash, you will need to invest some of your wealth into assets with an element of risk in order to have the prospect of achieving a higher return. The extent to which you need to do so provides a measure of your need to take financial risk. Together, these three assessments form a client's risk profile. We have found that clients that understand the risks that they are taking with their portfolio are more likely to have a successful investment experience and less likely to make the sort of decisions that damage their wealth. So the question is, do you understand yours? For more information about investing, please see the Bloomsbury Guide to Investing or reach out to us directly.